You've joined the second in our series of webinars, which we are hosting in partnership with the TMA, which are coming under the banner of Real Estate Restructuring Strategies Beyond COVID-19. And today, we're going to be looking at the real estate construction industry and in particular, managing development risk. As I'm acutely aware in my position in restructuring and also as a receiver from time to time, that there are various stresses and strains that the construction industry is under at the moment, and that development sites in particular are experiencing and are likely to continue to experience in the weeks and the months ahead.
I think the process of planning and information gathering, there's going to have to be much more emphasis on that. We see it very much as a partnership with contractors and supply chains to try and help manage this risk out. So I think that's going to require contractors to be more open with their programs and critical path and look at where the client team can help with that.
Personally, I can't see how this ultimately cannot impact negatively on land values in the short to medium term at least. But anecdotally, there do seem to be some signs of hope, and the evidence that we do have would not point to wholesale reductions in land prices. Ultimately, there is still demand for family housing and of course a shortfall in government targets. I think we might see land deals structured slightly differently perhaps, maybe with less money down up front. So we need also to be alert to headline pricing when we scrutinise the evidence that we do have.
I think initially over the start of the lockdown period, the majority of the PLC house builders put an immediate pause on land buying, furloughing the majority of land buying teams. And whilst they assessed the market and the impact of COVID-19, this resulted in a number of the house builders dropping notable transactions across London and the South East. However, the business of land buying, particularly for house builders, now seems to be firmly back on the agenda.
Having started in 2008, 2009, this time is very different. Our first deal that we ever conducted at Maslow was a loan to value of 5% and an interest rate of 15% in 2009. And today, I would say that's an interest rate of 5% and a loan to value of 60%. And that is really reflected by the mass liquidity that has that arrived in the market over the last decade and continues to be in the system. We do see a lot of lender activity during this time, a lot more lender activity than of course we saw when we started the business.
Do make sure that you're following Colliers on various social channels in order to get updates in terms of the recordings of these webinars and also the new events that we'll be bringing to you over the coming weeks.